to another episode of Let's Invest Right. Today we are going to discuss another key important fundamental, which is dividend yield. So SN, as we discussed earlier, earning yield. What's the difference in dividend yield and what do we mean by dividend yield?
See, dividend is something that directly goes as a cash to the shareholders.
Okay.
Earnings is the total earnings. So let me define earning per share and dividend per share.
Sure.
See, earning per share could be 100.
Okay.
Let's assume it should be. Earning per share could be $10.
Okay.
Per share. Dividend may be 0, maybe 1, maybe 10. It depends on the payout
It's a
ratio.
portion of those earnings.
Exactly.
Which is being paid off to
Correct.
the stockholder.
Correct. That's why we look at the payout ratio as well of the company. How much of the earnings the company is paying as a dividend to the shareholders. Now coming to the point dividend yield. As we discussed the earning yields. So dividend yield is the ratio dividend per share divided the price of the stock. So higher the dividend yield, the better it is in terms of for the investors. Now, but there are a couple of more things that I would like to add here. There are some stocks that don't give dividends. Should we invest in those? Well, let's discuss. We need to go into further into growing stocks will not give you dividends. Stocks that are mature, that are not volatile, that will give you higher yields. There are people that prefer keeping the investment or the cash in bank. I'll suggest them not to keep the cash in bank. Put it in stocks that are mature, that are giving dividends. You'll get a better returns on those rather than keeping those in the bank. Your money is getting devalued with inflation.
But it also depends because it depends upon the country where you're investing. Suppose you're investing in a country where interest rates in the banks are higher than the dividend yields. So it depends upon even those factors, right?
See, if your interest rate is higher.
As an investor, if I need to decide that which return is more, is it in the bank or in equity market?
The banks will not give you, in a mature or a developed market, will not give you a higher interest.
That's correct.
That's correct. Higher interest rate that you're talking about, you'll get in developing countries like India, like Pakistan, like Iran. They'll give you higher returns. But what will impact to the value of the money? It will get depreciated with the exchange rates. So these currencies are going down if you look at the trajectory,
That's
right?
correct. That's correct.
With the trajectory, it's going down. The value of the money will be less, even with the interest rate of 10, 12, 15%, like Iran is giving a higher percentage of the interest rate.
Correct. So it's very important for an investor. It depends upon the investor's interest, whether like I'm talking about choosing the stock. So the stock which is giving more dividends or whose dividend yield is higher than the other stock, there might be less volatility in those stocks. So how's the volatility of the stock linked with the dividend yield? Like dividend paying stocks, they are more volatile or less volatile?
Stocks that pay high dividends are not volatile. Okay. These are mature stocks like McDonald's, like all those mature companies, developed companies. The stock price will not be fluctuating with the markets. They will be going with the same or more or less with the same market or keep their price same. Or even you can see if the market is going up, you can see those price stock going up as well. So you'll get a capital gain as well as you'll get the dividends by buying those stocks.
As you've discussed about the capital gain, which is the difference in the initial price and the final price,
yeah.
That's the gain which the investor gets closing the position. The companies which normally don't pay out the dividends, you realize more capital gain. Is that the case always?
So stocks that are moving or volatile are those that are highly growing stocks. Mature stocks, you'll not find those to be jumping like 8%, 10% in the market every week, right?
Exactly.
So that's why these companies. So one more point I would like to add. It's important to define, as I discussed in the previous video, it's important to define your objective and goal of the investment. What you're trying to do. What you're trying to do in your portfolio. You want to have risky stocks, you want to have mature stocks, or you want to diversify. You want to have invest everything in dividend paying stocks, right? So you have to identify your objective and then stick to it and then invest accordingly. You want to go for capital gains, you want to diversify, you want to go for dividends or whatever. So it's important because you maybe take a higher risk. I may not be taking in a position to take higher
It
risk.
depends upon the investor's
Exactly.
appetite.
So they have to define their own strategy, own portfolio. That's it.
Correct. Thank you very much, guys, for watching us, and keep watching us and find about more important fundamentals. Thank you.